Today, we dive into an intriguing economic story taking shape in Southeast Asia. The Malaysian Ringgit, once under pressure, is now defying expectations and climbing the ranks to become one of the world's best-performing currencies. This sudden surge has caught the attention of investors, economists, and everyday Malaysians, who are all asking the same question. Why is the ringgit rising? And what does this mean for Malaysia's economy? Let's break down the factors that are driving this rally and consider whether this trend is sustainable or merely a temporary fluctuation. But before we get started, don't forget to hit that like button and subscribe to our channel to stay updated on the latest in economics and global finance. To understand the ringgit's recent rise, it's essential to revisit some key events from Malaysia's economic past. During the Asian financial crisis in 1997, the ringgit plummeted to 4.8 against the US dollar, a low point that led the government to implement unconventional economic measures, including strict capital controls and a fixed exchange rate of 3.8 ringgit to the dollar. These policies helped stabilize the economy and set the foundation for growth. Over the following years, Malaysia's economy began to diversify beyond its reliance on manufacturing exports. The government focused on developing high-tech industries, improving financial regulations, and investing in education, all of which contributed to Malaysia's economic resilience. By building a diversified economy, Malaysia reduced its exposure to external shocks, making it better equipped to weather global economic downturns. Fast forward to the present, and Malaysia's economic landscape has transformed significantly. In 2024, after nearly 3 decades, the ringgit has achieved record highs, appreciating over 14% against the US dollar and 6% against the Singapore dollar in recent months. This rise is backed by multiple factors, from US monetary policy shifts to Malaysia's strategic economic reforms. One of the most significant factors impacting the ringgit is the US Federal Reserve's recent decision to cut interest rates. When the Fed reduces its rates, it typically makes the dollar less attractive to investors, prompting them to seek higher yields elsewhere. Malaysia, with an interest rate of 3% compared to the Fed's previous 5.5%, has benefited from this shift, as investors pivot towards emerging markets for better returns. This interest rate differential has effectively drawn more foreign capital into Malaysia, contributing to the ringgit's appreciation. Furthermore, the Fed's projected series of rate cuts has fueled expectations of a prolonged weakening of the dollar, encouraging investors to consider currencies like the ringgit. Beyond interest rate shifts, the dollar's weakening also allows Malaysia's economy to become more competitive on a global scale. Since many global commodities, including oil and palm oil, 2 of Malaysia's major exports, are priced in US dollars. A lower dollar makes these exports more attractive to international buyers. This favorable shift in trade terms boosts Malaysia's GDP and, in turn, reinforces investor confidence in the ringgit. The Malaysian economy has shown resilience and strength, with recent GDP growth figures surpassing expectations. In the second quarter of 2024, Malaysia's GDP grew at an impressive 5.9%, exceeding Bloomberg's forecast of 5.8% and marking the highest quarterly growth rate since the onset of the pandemic. This economic performance has undoubtedly boosted investor confidence in the country. Breaking down this GDP growth, 2 main factors emerge: domestic consumption and a strong export sector. Household spending has been notably high, driven by government policies such as cash handouts, subsidy cuts, and seasonal spending. For example, Malaysia recently implemented cuts in diesel subsidies, which is expected to save the government around 4 billion ringgit, reducing the overall budget deficit. While subsidy cuts can be unpopular, they are instrumental in improving the country's fiscal health, further enhancing the ringgit's stability. Moreover, recent reforms in Malaysia's fiscal policy have aimed to broaden the tax base, improve revenue generation, and reduce the national debt, which stands at around 1.5 trillion ringgit. This financial prudence appeals to investors who prioritize stable, well-managed economies for their investments, further driving demand for the ringgit. In 2024, Malaysia's tourism sector has made a remarkable recovery, generating around $20 billion annually before the pandemic. After a near-total shutdown during COVID-19, tourism bounced back, achieving a record quarter with over 64 million visitors and generating nearly $85 billion in revenue, a 32.5% increase from the previous year. Tourism now accounts for approximately 10.5% of Malaysia's GDP, contributing significantly to the demand for ringgit as visitors exchange their currency for local spending. Foreign direct investment, FDI, has also been a game changer for Malaysia. The country has positioned itself as an attractive destination for high-tech industries, particularly in data centers and semiconductors. Between 2021 and 2023, Malaysia approved $15 billion in investments for data centers, attracting giants like Amazon, Microsoft, and Nvidia. In Johor, the country's data center capacity is projected to exceed that of regional competitors, including Singapore. Lower electricity tariffs, 10 cents per kilowatt-hour compared to Singapore's 27 cents, and a 100% tax exemption for AI and cloud data centers have made Malaysia a prime choice for tech investments. This influx of foreign capital directly impacts the demand for the ringgit, as investors must purchase the currency to set up operations. Additionally, as data centers and tech hubs expand, Malaysia is likely to see an increase in high-value job creation, which boosts local consumption and further strengthens the economy. Malaysia has strategically positioned itself to benefit from the US-China trade tensions, with companies seeking to diversify their semiconductor manufacturing locations. Taiwan's TSMC, for instance, produces over 50% of the world's semiconductors, but rising geopolitical tensions have prompted firms to explore alternative manufacturing sites. Malaysia's combination of affordable labor, English-speaking workforce, and STEM-educated graduates makes it an appealing location for semiconductor production. Moreover, Malaysia's unique geographic position, free from natural disasters such as typhoons and earthquakes, adds to its appeal as a manufacturing hub. Unlike some neighboring countries, Malaysia has minimal risks of natural disruptions, making it a safe and reliable place for long-term investments. While Malaysia is not as cheap as countries like Vietnam, its infrastructure quality, government support, and low natural disaster risk make it an appealing alternative for high-tech manufacturing. This positioning has helped Malaysia weather external shocks, reinforcing its status as a stable economy in the region. While a strong ringgit has advantages, such as making imported goods cheaper and increasing Malaysians' purchasing power abroad, it also poses challenges for Malaysia's export-driven economy. In 2023, exports accounted for around 67% of Malaysia's GDP, with key products like electronics, palm oil, and petroleum. A stronger currency can make Malaysian exports more expensive, potentially leading foreign buyers to seek cheaper alternatives from other countries. For example, palm oil, a major export, has seen price adjustments as the ringgit strengthens against the dollar. The semiconductor industry, a growing segment in Malaysia's economy, is particularly vulnerable to these currency fluctuations. If the ringgit remains strong, companies may experience revenue drops as they are paid in foreign currencies that are now weaker relative to the ringgit. Despite these challenges, Malaysia has continued to attract foreign investments, indicating that the overall economic environment remains favorable. Another key driver of the ringgit's appreciation is the government's focus on encouraging companies to repatriate earnings back to Malaysia and convert them into ringgit. This policy, implemented by Bank Negara Malaysia, increases demand for the ringgit in the foreign exchange market, as companies that hold foreign currencies are incentivized to bring their funds back to Malaysia. This policy is not entirely new. Back in 2016, Malaysia mandated that exporters convert 75% of their earnings into ringgit. Although the policy was later lifted, it underscored the government's commitment to stabilizing and strengthening the national currency. As Malaysia's economic fundamentals improve, companies that once hesitated to repatriate foreign earnings are now more willing to convert to ringgit, further boosting its demand. China, one of Malaysia's largest trading partners, plays a significant role in the ringgit's recent strength. As China implements economic stimulus measures, demand for Malaysian goods has increased, strengthening Malaysia's export sector. Trade between Malaysia and China grew by 10.8% in the first 7 months of 2024, further boosting demand for the ringgit. Additionally, when comparing the ringgit's performance to other regional currencies, Malaysia stands out as the top performer in 2024, surpassing neighbors like Singapore, Thailand, and Indonesia. This outperformance reflects not only US dollar weakening, but also Malaysia's improving economic fundamentals. Despite its recent successes, Malaysia faces ongoing challenges. The middle-income trap, where living standards stagnate after reaching a certain threshold, remains a concern. Malaysia's per capita income still lags behind higher-income countries like Taiwan, South Korea, and Singapore. Addressing this issue requires investments in workforce upskilling, higher productivity, and developing high-value industries. A 2024 survey revealed that 70% of young Malaysian employees would consider leaving the country for better opportunities abroad, signaling a potential brain drain. Malaysia's low cost of living and relatively high quality of life are advantages, but retaining talent will be crucial for sustaining economic growth and supporting a strong ringgit in the long term. To combat this brain drain, Malaysia could consider bolstering local opportunities by investing further in high-value industries and creating incentives for Malaysians abroad to return. These efforts could fortify Malaysia's talent pool, helping maintain the economy's competitiveness. Looking ahead, analysts are divided on whether the ringgit's rise will continue. The currency's strength depends on several factors, including the Federal Reserve's future interest rate decisions and Malaysia's ability to sustain economic growth. If the Fed continues its easing cycle, it's likely that the ringgit will maintain its strength as investors seek returns in emerging markets. Additionally, Malaysia's own central bank, Bank Negara Malaysia, could adjust its rates in response to global shifts, influencing the ringgit's trajectory. If Malaysia can maintain its fiscal discipline, attract ongoing foreign investment, and navigate the challenges posed by a strong currency, the ringgit's recent rise may be more than just a temporary phenomenon. The economic policies and structural reforms implemented in recent years have laid a solid foundation for sustainable growth, and as long as these measures remain in place, Malaysia could very well establish itself as an economic powerhouse in Southeast Asia. The story of the Malaysian ringgit's ascent is more than a tale of currency fluctuations. It's a narrative of economic resilience, strategic policymaking, and a nation poised for growth. Malaysia's journey from crisis-era reforms to a modern economy has involved a delicate balance of fiscal discipline, foreign investment, and domestic consumption. While challenges remain, Malaysia's ability to adapt and leverage global trends is a promising indicator of its potential. In a world where economic uncertainty is the norm, Malaysia's rise offers a blueprint for other emerging economies. The key takeaway? Strategic planning, adaptability, and a willingness to innovate can transform vulnerabilities into strengths. As Malaysia's economy continues to evolve, the ringgit's trajectory will be a telling indicator of the country's ability to thrive in an increasingly interconnected global landscape. Thanks for watching, and don't forget to like and subscribe for more insights on the global economy and emerging markets. Let us know in the comments what you think. Will the ringgit's rise last? And what does this mean for Malaysia's future?